Okay, for more on the market massacre, we're joined by Charles Ortel. He's the managing director of Newport Ventures. Charles, thanks for joining us.
Thanks for having me on.
What do you make of today's major sell-off?
Well, I think anybody who had plans for summer vacation better cancel them. The elephant in the room that most professionals have been focusing upon for some time is that the largest financial institution in the world, the Federal Reserve, is in fact a weak financial institution when you look behind the curtains and you look at their financial statements. Their ratio of equity to total assets is very, very low. And notwithstanding that, notwithstanding the small equity cushion, they have been able to get away with an unusual policy from 2009 to the present of keeping short-term interest rates extremely low and also suppressing 10-year interest rates. That is not what happened from 1962 to 1999. Rates were much, much higher, both at the short end and at the long end. And I think the pros have finally figured this out, and there's blood in the water here.
So you think it's more to do because we've extended the bond buying program for so long, rather than that it's winding down? I mean, is that what you're saying?
Well, I think actually that there are a series of structural problems besetting the global economy. But what made everything work is that if you were a connected financial institution or a connected player in the United States, you could borrow overnight at 15 basis points annualized, and turn around and invest in treasuries, getting a 2.77 annualized yield. If you felt you would get a nudge and a wink, that policy would change, you were safe.
Well, some people are saying that the markets are overreacting to this because ostensibly what the Fed is saying is that when and if the economy improves, then they will start winding down the bond purchases. So that will be good. They're saying, you know, we'll wait for unemployment to be below 6.5%, for GDP to be at 3%. Surely that would be good news. So surely then the fundamentals would kick in when this purchasing tapering begins as well.
I think that's a nice theory, but in reality, when you look at long time series data, which most people don't do, when you look all the way back, say, to 1962 on these interest rate trends, you see how abnormal the period was.
Now, you're focusing a lot on interest rates, but as yet, Bernanke said he's not touching them.
Well, it doesn't matter particularly what he says. It matters what people believe will happen. And I think what people are now doing the homework they should have done a long time ago, and they're concluding that there's been an artificial prop to all asset values around the world in these suppressed U.S. interest rates.
Okay, well, the artificial stimulus has what's been keeping us up on this sugar high. I want to bring in my colleague, co-anchor Phil in D.C. Phil, you want to jump in here?
Yeah, I was just listening to the conversation, obviously, and one of the things that struck me is, let's just say, for example, Charles, that the business team bought lottery tickets and we won $10 million. And give me one reason why we should put any money into the stock market right now at all.
Well, you should put money into the stock market if you believe that the entry prices offer you a margin of safety. That is to say, if you believe the prices are low. By any set of historical measures on cash flow, on forward earnings, stock prices for most American companies remain stratospherically high and dependent on this sugar high. So I actually think, and I can tell you that the pros I know around the world have been retreating from the stock market over months. Many of them are now short, anticipating the bloodbath that could come.
Well, I mean, that's a good point, because you're probably looking at some of the same research notes that I'm looking at as well, and the conversation is the same, right? We were sort of borrowing U.S. dollars or low on interest rates and then going long all the emerging markets, and now that trade is basically reversing itself. This deleveraging process, this selling of stocks from around the world, how long do you think it could last for?
Well, I think we're in an unprecedented situation in modern history where every major economy in the world has problems. And so you could actually see a pronounced sell-off unless there is concerted central bank intervention for a period of weeks or months. I don't think you've delayed this problem much past the putting together of year-end numbers in this country, which come around December 31st. So the longest respite you can have might be to, let's say, January, February, and the shortest set of problems you could have is a very bleak summer.
So 2 points here. Firstly, as Phil mentioned, the global economy is looking very bleak overall, and many have said that, you know what, still the U.S. markets are the lesser of all evils, and people were still getting most of their returns on U.S. equities. So is that not going to continue? Could this be just like minor shock value against the Fed, and in a couple of days people will kind of recover and go back to US markets because they still are the lesser of all evils?
Well, when interest rates were as low as they were in the United States for as long as they were, investors didn't do the type of homework here to understand the intrinsic value of equities. Now that interest rates are back on the way up, you're going to begin to see, I think, more and more people say, you know, I've had enough of a ride off the March 9th, 2009 lows. Let's take my bait off the table.
Right.
Let's wait and see what happens here. And I think in the ensuing weeks and months, what people are going to realize is that every major government in the world has troubled finances. Ours, every major European, Japan, China, India, Brazil. So there's going to be upward pressure on sovereign debt rates, I think, around the world. At the same time, there's inflation. So the central banks don't have as much leeway to keep short-term rates low.
So if everybody's pulling out of equities because central banks can't keep the stimulus, where would you be putting your money right now? Because commodities don't seem to be doing much better at the moment.
It's a very difficult question. I mean, if you're a large investor, you're in serious trouble because you need to put, you know, 100 million, $1 billion to work. And what market is deep enough for you to do that? I actually think the gold sell-off is artificial. I think that what's happened is a number of leveraged hedge funds had to sell their positions. And I think there's artificial pressure downwards on gold.
So gold down 6% today. You think gold's making a comeback? Now's a good time to buy gold?
I'm a long-term investor. I think this is a good time to add to your physical gold position, particularly if you can keep it outside the United States and Europe in a safe place.
Physical gold, gold coins, gold bars is what you're telling me.
Yes.
Under your mattress. Okay, very old school. Now, Charles, renowned economist Nouriel Roubini, amongst others, has said that any Fed exit, and I quote Roubini, will be treacherous. Are we beginning to see this treachery? What should the Fed be doing then? I mean, it's in this mess, or it's already in the situation. Very quickly, what should and could the Fed be doing?
Well, I authored a fake State of the Union address right about the time of it, a Compact for Prosperity, where my first point was that the Fed should basically adopt a hard money standard. We should audit the Fed in a much tougher way than any bank in the world is audited, and that the Fed, I believe, needs $1 trillion equity infusion, which we could do if we allocated a portion of the United States' excess federal lands for equity into the Fed. If you go back and you look at the history of U.S. growth from 1981 to 1989, we had a strong money policy. And
what does that mean for our viewers? What does a strong money policy
that
mean?
means high interest rates. Actually, when you have high interest rates, investors around the world will flock to the U.S. dollar and they'll put even more money inside the U.S. So I think that's a good idea for us.
Okay, well, the U.S. dollar has been strengthening today and recently. We're going to have to leave it there, but thank you so much.
Thanks for having me on.
Charles Ortel, Managing Director of Newport Ventures.